Please don't be dumb money. Look at the signal first. The Federal Reserve cut the policy rate on October 29, 2025, then set balance sheet runoff to end on December 1st. That is easing while inflation still sits above target. The contradiction is the point. It means policymakers fear tightening liquidity more than sticky prices. Watch what happens next. Check the system context. Treasury kept November refunding coupon sizes unchanged while planning more inflation-linked supply in December. Dealers must absorb steady coupons as reserves stop shrinking. That pairing rarely lasts without a price. The last time policy eased while supply stayed heavy, risk assets cheered before funding stress returned. The mechanism works like this. Coupons carry a coupon, the fixed interest rate on a bond locked at auction. As older debt issued near 2% rolls into four-handle coupons, interest costs rise. Term premium, the extra yield for long bonds, has turned positive again. Real yield, the rate minus inflation, remains high enough to compete with equities. Translation: money has options outside stocks. So what happens when headlines say record highs while funding math tightens? What breaks first? Follow the money. 3 forward dates now anchor the tape. November 10th through 13th brings the quarterly refunding auctions. November 13th drops the October Consumer Price Index. December 9th and 10th sets the next Federal Open Market Committee decision. That calendar compresses flows, data, and policy into 1 month. Picture a crowded doorway. People can exit. Not everyone can exit at once. Notice the positioning tell. Exchange-traded funds saw large cap inflows through October. At the same time, futures data showed dealers leaning long index exposure while hedging tails in options. That is not universal confidence. It's a barbell. Chase upside, rent protection. The result? One-sided flows can whipsaw when a data point surprises. The pattern emerged in 2007. Funding spreads looked calm in May. By August, commercial paper seized. Today, funding indicators look contained while the maturity wall, when lots of debt comes due at once, keeps moving closer for corporates and sovereigns. Translation: calm data, pressure underneath. So far, policy eased while supply stayed steady. Coming up, where dumb money shows up in the data. Watch the definitions before the debate. Yield curve. The relationship between short and long rates has been inverted, then steepened as the front end fell faster after the October cut. If long yields hold high while the front slips, that is bear-steepening's echo. It signals growth doubts and supply pressure. Auction tail. When demand is weak at a Treasury auction shows up when buyers insist on a higher yield at the closing. Primary dealers, the banks required to bid at Treasury auctions, can warehouse the risk, but only for so long. Check this contradiction. Stocks climbed into late October, while the Fed ended quantitative tightening on December 1st. If liquidity was ample, runoff would continue. Ending runoff is an admission. Reserves ran tight. That's not boom energy. That's triage for the plumbing. The math doesn't lie. The numbers prove the stress points. The policy rate now sits in a 3 3/4 to 4% range. November refunding holds about $42 billion in 10-year notes and $25 billion in 30-year bonds. The inflation print on November 13th decides whether real yields stay elevated. Why it matters. If real yields stay high, duration remains competition for equities. Picture this pause. It's like a stadium with more exits on paper than in practice. The map shows doors everywhere. The crowd still narrows into 2 actual corridors. The constraint is simple. Issuance must clear. If long buyers bulk, term premium rises. When term premium rises, valuations that depended on falling discount rates face arithmetic, not narrative. That is when dumb money appears. It buys the highest price while the financing gets dearer. What changed in the last 30 days that will decide whether this becomes a soft repricing or a hard stop? Follow the money again. The US Treasury announced tip sizes for November and December, including a 5-year reopening increase in December. That is supply aimed at inflation hedging demand. If core inflation keeps sliding into winter, those bonds clear. If it flickers higher, the whole mix reprices. Watch the timing. Look at history for balance. In the late 1990s, the Fed held steady while growth ran near 3%. Equities soared. Then, when long rates rose and risk capital tightened, the unwind took 3 years. The echo is not one-to-one. Different technology, same financing math. That's when the digestion beat matters. Rollover refinancing old debt with new debt does not fix the bill. It just changes the rate. If the new rate is higher, cash flows shrink. Translation: less room for buybacks and capex. So far, we mapped the calendar and the rollover math. Coming up, how to spot dumb money behavior without looking at retail flows. Check the 3 tells. First tell: buying price-insensitive products into an accelerating issuance window. Second tell: ignoring auction tails while celebrating new highs. Third tell: calling every policy ease stimulus, while the Fed explicitly ends balance sheet runoff to stabilize reserves, not to juice risk. Now the pressure builds. If the October CPI release on November 13th prints hot, real yields will push up again unless nominal rallies harder. If it prints cool, long buyers may still demand extra compensation for duration. That is term premium again. Either way, the cost of time is not free. Think of it like refinancing a mortgage, except at double the old rate. The house is the same, the payment is not. Open question: which player blinks first, issuers, buyers or policymakers? Follow the institutional behaviour. Sovereign wealth funds, government investment pools tend to buy weakness, not euphoria. Pension funds rebalance on rules, not vibes. Primary dealers can buffer auctions, but balance sheets have limits. When all 3 lean cautious at once, the crowd's momentum hits a wall. Watch the timing. The Fed's October 29th move took the policy rate down by a quarter point. The statement also set December 1st as the end of balance sheet runoff. That gives the system 2 weeks between the CPI print on November 13th and the policy meeting on December 9th and 10th to decide if financial conditions eased enough. Translation: the window is short. The signal was hiding in plain sight. Look at spreads next. The gap between 2 interest rates stayed narrow in credit, even as real yields rose this fall. That mismatch can persist until one side catches up. If credit widens while stocks sit near highs, funding finally speaks. If credit stays tight, equities can levitate longer. Either way, the clock runs into those 3 dates. This has happened before. In 2007, spreads stayed calm through early summer, even as housing cracks spread. By August, structured funding snapped. The outcome was not immediate. It was inevitable once the arithmetic flipped. What happened then is simple. Leverage made the shock bigger. Today, leverage hides in product structures and private vehicles. The result? Less daily visibility, same physics. So far, the tells are price-insensitive buying, auction apathy, and term premium drift. Coming up, who is dumb money when institutions dance the same tune? Notice the gap. Dumb money is not a person. It is a flow that ignores constraints. When policy, issuance, and real yields say caution, and price chasers still buy anything with a ticker, that's the dumb flow. The label is about behaviour, not identity. The mechanism works like this. Investors crowd passive funnels at record clips. Issuers feed supply at steady sizes. Policy eases because reserves feel tight, not because growth is booming. One small surprise, a weak auction, a hot CPI, or a hawkish press conference, and the one-sided flow flips. The pattern showed up early. Check this contradiction before the calendar. Headlines celebrate easing. The Fed's actions say liquidity is fragile. Barricades in plumbing, not fireworks in growth. The dollar can stay firm while stocks rise. That is not currency collapse. It is doubt about the plan's staying power. If December 10th delivers a cautious Fed, who carries the long end? Follow the money, find the pressure. 3 dates decide the next move. November 10th to 13th for refunding, November 13th for inflation data, December 10th for policy decision. If refunding tails widen, funding costs jump. If CPI cools, pressure eases. If the Fed stays on hold after October's cut, markets must price that restraint. Picture the bridge analogy. A bridge holds weight until the bolts loosen. Each extra truck looks small. Together, they matter. That's when pressure builds. Now the mid-script cliffhanger. If the November auctions tilt long and tails widen, the snap seen this month will not be the last. If the CPI print runs hot, December's room to ease shrinks. If both hit at once, the crowd's exit narrows. So far, the calendar framed the risk. Coming up, translate every technical term into what to watch on screen. Look at translators in action. Term premium, the extra yield for long bonds. Rising means long buyers want more pay. Real yield, the rate after inflation high, means safe income competes with stocks. Auction tail weak demand means the issuer pays more to clear. Spread the rate gap widening means lenders demand protection. Primary dealers required bidders can carry only so much. The signal appeared where few looks real yields. Check the scoreboard into year end. The policy rate is 3.75 to 4. The Fed halted runoff on December 1st. The CPI printing on November 13th sets real yield math. The refunding cadence on November 10th, 12th and 13th tests term premium. The FOMC on December 10th explains whether easing is a trend or a pause. What does easing with brakes on do to crowd behaviour? The result? A market that can levitate on momentum until funding says no. That is how late 90s episodes stretched for years. It is also how 2007 flipped within weeks. The common link is time cost. When the cost of time rises, price chasers become liquidity providers without meaning to. Think of a credit card. Minimum payments look small at first. Then the rate resets. The balance barely moves as interest eats cash. The math revealed the gap. Follow the policy constraint to the close. The Fed does not target equities. It targets jobs and prices. Ending balance sheet runoff protects reserves. It does not promise a rally. Treasury must still sell bonds. Buyers still demand terms. That is the constraint. So far, definitions translated, calendar set, history echoed. Coming up, the 3 warning signs that separate smart from dumb flows. 3 things to watch that separate discipline from the crowd. 1. Auctions, firm or soft. If tails widen and dealers take more than usual, funding costs rise. That strains high multiple stories. 2. Real yields, rising or falling. If real yields firm after the CPI release, duration stays a competitor to equities. That pins valuations. 3. Central bank flows. Adding or pausing? If the Fed pauses after October's cut and runoff already ended, that is a signal. Liquidity support is finite. Now the calendar countdown. Again, in one line. November 10th through 13th. November 13th. December 10th. 3 dates, 1 story. Watch what happens next. Scorecard before the close. Auctions, firm or soft. Real yields, rising or falling. Central bank flows, adding or pausing. Institutional behaviour observation, not personal advice.